So this is the 6th episode of our ongoing series of Cardinal Lessons dealing with the financial plan for Tom and Susan. And today we're building their income plan and their investment plan. And frankly, a lot of people, they think CSPs, this is all we do, is we help you with your money. And we certainly do that, and we feel like we do it well. But this financial plan in this series that we're showing an example is going to cover all 7 of these areas, and it's going to show them all mixing together. So I want to bring Tom on. I want Tom to share, why are we doing this video today, Tom?
Yeah, I think we're doing this video because when you really boil down people come in with all sorts of questions, about Roth conversions, Medicare, Social Security, investments. When you boil it all down to the base level, really what they want to know is, are they going to be okay in retirement? Do they have enough to be able to do the things they want to do when they want to do them and have that last the rest of their life? That's it. That's ultimately what really we're doing with a lot of these plans. And one of the most important pieces of that is the income, and specifically how much can they spend, right? If you have someone with, $10 million, but they spend $1 million a year, the answer is no, you can't. When I have somebody with 200,000, but they only spend their Social Security check, they can. So it's all related to the income of what they're able to live off of. So we need to get really clear what that income plan is, show you how that works, and that's going to let you go into retirement with that confidence that you're going to be okay, not just now, but an 85-year-old self is going to be okay, right? We need to make sure this lasts for the rest of your life and not just like the next couple of years. And so let me bring up the show notes. You can find these at the link below our video. They're also on our website at cardinalguide.com. We have the board. We have the plan that we've been going through this series. We're going to reference back to this as we go through the show here, but read through it. Again, every plan looks a little bit different. This is specific to Tom and Susan. But again, this is the typical sort of process we do when we're doing a financial plan for our clients. So let me turn it back to Hans, and we'll go through the board here.
Okay, so this is the 6th of 8 shows. And in the beginning one, the first one goes over what we're doing. And then the next 7 just go down the boxes, and it shows the part of their financial plan. Like when we were doing Social Security, the first one, which is Social Security planning necessary at retirement. We did all that. We talked about that, but it's impossible to talk about Social Security without touching all these other plans. In the show notes, in this video and the other 7 of them, is the financial plan for Tom and Susan. So you can go in there just on this video, you can pull it up and you can look through the whole thing that we prepared for them. Now, I want to emphasize to people, we do this in 50 states and the District of Columbia. We serve people all over the country. We're licensed in all those places, registered. We're good. And so if you're interested in one of these things, or you're interested in hiring us or consulting, we charge $1,000 for a basic financial plan or a comprehensive financial plan. And I'm just not offering this to everybody. We have some criteria. But I want to let you know is that don't let your geography stop you from consulting with us. We work with people all over the country. We do it by Zoom. So what we've got in the income plan, which is what we're doing today, is we've got 4 considerations. The income plan itself, but before we can create the income plan, we got to look at the investment plan. We got to look at how the money's invested, how it's going to go up and down, and the dividends that it produces and the gains, because that's what's going to create all the income, and how we manage risk. And then we got to look a little bit around the estate plan. And it's just, so now we're jumping into another area where we're going to be talking about estate planning, but it's only in terms of income. So if with Tom and Susan, one of them may pass away at 80 and the other one lived to 95. And so we got to plan, we got to look at what happens to the income when the first one passes away, and what's the survivor or the widow left with. That's probably the biggest thing that we're looking at in the estate plan today in this video. And then the last section is the tax plan. What it really boils down to is you can't spend tax money. So what we're going to do with clients when they come in is, first we're going to figure out, what do you need to live on? What's your amount of money that you have to spend every month to live. Okay, and that's a number. And then with Tom and Susan, that was probably $5 or $6 grand a month. Okay, and then how much do you want to spend? Now we get beyond need and we get into want, and those two numbers added up to $10,500 a month after we did a bunch of work. But you'll notice what's not included in there are taxes, because you can't spend tax money to live. In other words, you got to pay taxes on your income to arrive at a net number. So we had to calculate the tax that Tom and Susan are going to have to pay to arrive at a net $10,500 a month that they can freely spend every month. Because 30 days later, there's going to be another 10,500 and so on and so forth. And then in the income plan, we adjust that by inflation of 2.5% each year for the rest of their lives. Okay. And so I'm just giving you a little peek into that. And so what Tom was saying is people come to us and say, can I retire? Do I have enough money to live? And I wish it was that simple. I wish we could just look at a few things and say, yeah. But in reality, that's all they want to hear. What we're talking about today is everything we do, from the question to the yes or the no or the maybe, or that we need to adjust some things. So jumping into the income plan, we build our income plan from the bottom up instead of the top down. And what I mean by that, when we ask people, well, how much do you need to live? When we ask them, because we have to, how much are you looking for in retirement? Well, people say 100 grand. Okay, so you say 100 grand. Is that before or after tax? People say, make it before tax. And it's just, and if they say make it after tax, well, then you're really going to need 140 grand to pay the taxes. So what we're learning about this person is they haven't put a lot of thought into it. They definitely need to hire us, and we're going to get in here and we're going to get this down, because that's a top-down approach. It's just give me a number on the top that I need, and then I'm going to show you all the taxes you're going to have to pay and how this is going to flow out to you. With our thing, we're going to start with you, create how much you need, how much you want, because you're not retiring without wants. I mean, most people want to travel, they want to do things in their leisure, maybe they want to get another house. I mean, there's all kinds of things. That's when you go to retirement, you want to spending your money. So need is here, and then wants is there, and we kind of make wants needs, and we're going to arrive at a number. Okay, so we've got that number, and now we're going to plan for that. So Tom?
Yeah, I mean, I think that is certainly the approach that we take. And I think it's a more useful thing, because really what we're trying to do is look to see, okay, how much money do you want and need? Let's try to solve for that. And that's going to take X amount of your dollars, right? However much money you have, and we're going to dedicate that money to the income. That's going to leave the rest of the money available for other things like growth, sort of one off expenses, helping kids, charitable giving. I mean, we got some other things we could do with the other money. But I think approaching it from that way is let's solve for the income based off sort of the after tax number. We can help solve for the tax piece of that, right? That's part of what we're doing in our planning. But let's start with that number, and then we work backwards from there, as opposed to, a common thing that gets thrown around is this 4% rule, which I think it's a useful sort of guide to give you an idea of sort of what level of spending around about that you could afford based off your balance. But instead of starting with your total money and then trying to arrive at a number, let's start at what your actual spending is and what you want to spend, and we work backwards to solve for that. So that's sort of just the approach that we take. I think it's a better way to do it. Personally. But again, there's other ways to approach this. For Tom and Susan specifically, let's sort of get into the details here. Is they started, if you remember back to our Social Security video, is they made the decision to go ahead and file for Social Security right as Tom was retiring. It lined up with Susan's full retirement age. She gets the spousal benefit based off Tom's working history. We have a Social Security video. You can go back and watch that. But at the end of the day, what that was going to produce is $6,294 a month. Now that's gross. I'm working with gross numbers here. That is the amount from Social Security they're getting. That's well on their way to the $10,500. but it's not fully there yet, right? And again, we need to account for the taxes. And so when we sat down and looked at how much additional money would they need to be able to net after federal and state taxes the 10,500 amount, what we arrived at was about another 6,000 a month of gross income. So their gross income is going to be closer to just over $12,000 a month. We net out the taxes, they can get the 10,500 and go on that way. So okay, how do we create this additional $6,000 a month? One way to do it is just leave the money invested like it is and make withdrawals of 6,000 a month out, which you could do. We have some clients who choose to go that way. The problem with that is it brings in risk, right? It brings in market risk, it brings in interest rate risk. Investments fluctuate, right? They go up, they go down, and when we're planning for the rest of your life, we don't know what the next 30 years look like, right? I mean, we might have a sense that it's going to go up over time, but any given year could be down. It could be down a lot. It could be flat. And at the meantime, we're still pulling out $6,000 a month, which can be risky. It brings in another risk called sequence of returns risk. Don't want to get too far into the weeds on that piece of it today, but if you Google it, you'll see that what that's talking about is it depends on, as you're living off the money, when those returns happen. Do the negative returns happen early? Do they happen later? Makes a difference in terms of sort of the ending balance. Again, I don't want to get too far down that rabbit hole. But what we decided for Tom and Susan is let's design a plan with the use of annuities, really designed to solve for that 6,000 a month, which again is going to net them the 10,500 they need. And what we ended up doing is recommending two separate annuities. One is called a SPIA. And let me bring up the show notes here, and you can solve. This is in the plan, so if you pull it up, you can read it. But this first annuity is designed to start paying income right when they retire, which in their case was October of 2026. And so we started with 6,000. We worked backwards and said, okay, what company has the best rates for these 5-year SPIA? Again, this one's only going to pay for 5 years. I'll get to that in a second. American National happened to win then. It might not when we're doing the plan for you. We have software where we can quote all this out to see what makes the most sense. But really what this one is designed to do is start creating income as soon as he retires to get them that additional $6,000 a month. For them, it took $316,000 of their IRA. You can move it from an IRA to the annuity company. That is not a taxable event. That's a question I often get. So you're moving it from one IRA where it is now to an IRA with the annuity company, and then it sits there. And as the income comes out, as that 6,000 comes out, that's when the taxes are due. Typically, we just withhold the taxes off the check to net the amount they need. So that's annuity number one. Later on, I'll show you how that relates back to the software. You say, okay, that's great. That works for 5 years. What happens at the end of 5 years? Well, with this one, that annuity stops, right? So that payment's done. Well, that's where the second annuity comes into play. I'll go there for just in a second. One other thing I'll make a comment on this one is if both of them were to die during those 5 years, because we'll get this question too, is the beneficiaries would get the remainder of the 5-year payment. So someone is going to get 5 years worth of payments from this annuity. At the end of the 5 years, the income is done. But then in year 6, right after 5 years, this is where the second annuity comes into play. This one starts as soon as that one stops. Again, solving for 6,000 a month or 72,000 a year, and that then is guaranteed for the rest of both of their lives. And so that's going to cover as long as either one of them are living. They're going to get a check for $6,000 a month. And the real beauty of this type of annuity is it can create that 6,000 a month off of zero balance. So if you live long enough, as you start withdrawing money from this annuity, the account balance will eventually reach zero, right? If you live long enough. What's nice is that 6,000 will still continue coming in as long as either one of them is alive. If you left this in traditional investments and you started making $6,000 a month withdrawal out of it, and you add in poor performance on this piece of the money or not great performance, you would have the same issue. Eventually, it would run out. But in that scenario, the income stops. What's nice about this is the income continues and it goes on into the future. We'll probably get more into this, but I want to turn it back to Hans and see what comments he has on these right now.
Yeah, I mean, the gist of the income deal here is these people have about 1.8 million of money, plus they got a big Social Security check. Is that how can we guarantee that they're going to have an income for the rest of both of their lives? I mean, in all scenarios. one of them could die at 80 and the other one lived to 95. They could both live to 95. They could both live beyond that. And so we got a lot of things to think about when we're answering that question that I went on in the beginning. Do I have enough to retire? Well, it's going to depend on a lot of things. And for them, it was $10,500 a month is where we ended up with that they need to be able to spend for the rest of their lives. And then, then we got to increase that by inflation every year, 2.5%, and that's in the software. And that's quite a big number when you get out in your 80s and 90s. And so when we run that through, and we're going to show a Monte Carlo simulation without the annuities, I mean, certainly there's some scenarios where they'd be better off not buying the annuities. They'd be better off just investing all the money, pulling out the income. But there's also a number of scenarios without the annuities where they run out of money. And so what the annuities do is just provide them the guarantee that, look, I'm going to have a certain amount of money coming in, even if there's only one of us surviving, and that's guaranteed by an insurance company. It doesn't matter how long I live. So that's kind of our thinking. And so these folks have almost $6,300 a month in Social Security starting right when they retire. And then they also have these annuities, which is going to start right when they retire, $6,000 a month, guaranteed, no matter what happens. They're going to be collecting checks, either two of them or one of them, for a long, long time. Those guarantees are just are great. So anyhow, so then we got withdrawals from qualified or non-qualified accounts. Then we get into the issue, are we, because initially we're going to have to take some money out of their investment account every month to make up the difference. And you're going to see that in the plan that Tom shows you. And then are we pulling that money out of the IRA or are we pulling it out of the non-qualified account? And most likely we're pulling it out of the IRA. So that's an issue that we need to deal with. The annual inflation spending is inflation adjusted, that I already went over. The income tax is calculated on top of the $10,500 a month, so that, as I said, we build them from the bottom up. This plan is essentially going to account for their spending, and then inflation adjust that. And the last point that I want to make is this is a plan of the next 30 years. There's so many variables. Like, we're not guaranteeing that this is going to happen 30 years from now. We're simply projecting that with what we know. And I just want to make a point that this isn't going to be the last time we're going to see you. We're going to stay with you all the way through retirement. And every year, we're going to be making adjustments to this plan, maybe adjustments to your spending based upon how all this stuff turns out. Tom?
Yeah, I mean, I think plans, plan is really just a snapshot in time of where we are now and then looking forward, which is a helpful exercise. I think it's great. We do it. We do a lot. I think people get a lot of value out of it. But really, the value becomes in the implementation and then the updating and monitoring of the plan. Because at the end of the day, life happens. Things change, things that we don't predict, and we need to be flexible enough to adjust that. And again, that's why the annuities are great, right? It removes any of the market risk. It has the income coming in guaranteed, which is wonderful. But we don't want to do it with all of your money, right? We need to have the rest of the money off to the side, still invested for growth, still doing other things, still liquid and access to it. So again, that's where building this as part of the larger plan makes some sense, because we sort of have solved for the income over here. We have the remaining money over here that we can invest. We'll get to the investment section in a second, that we invest that, and then we have, flexibility with this piece of the money. So we're sort of putting these in different pots, doing different things, and that money has a job, right? This money's job is the income. This other's money job is the growth and sort of giving, or leaving money to the kids, estate planning, all that stuff. So when we think of the annuities as part of a larger investment plan, we'll get to the investments here, is we want to view those as like a fixed income substitute. So fixed income bonds, money market, stuff that's not going to have as high of a return, but provide some more stability, some more diversification away from equities. Annuities serve a very similar role to the bonds would in a larger portfolio. So when we think of the larger portfolio construction, if the annuities are serving as a bond allocation, that means we can take a little bit more risk, more equity exposure in the remaining money, which is going to have a higher expected return because we have our safety over with the annuities. And so let me show you, we have a section in the plan. I'll bring up the show notes here. Now we get into the investment of the plan here. And so if you go back and watch our first video, they have about a 60-40 portfolio coming in, maybe 55% equity, 45% fixed income, which they felt is appropriate for going into retirement, which I would tend to agree. That seems about right. Some people are a little bit more risk averse. They might have a little more equity or more bonds. Some people are okay with more risk. They might have a little bit more equity, but somewhere around there is a typical sort of asset allocation for someone in retirement. And so that's where they came in. They thought they were doing great. They weren't doing anything necessarily hugely wrong. But what we showed them is, okay, if we do the annuities, now we can be more aggressive with the other money, which is going to have more risk, it's going to have more volatility, but it's not impacting our income, right? Our income isn't being affected by that market movement. And over time, you would have a higher expected return with the remaining money because we have the income covered over here. And so what this chart does is it really shows you sort of this purple line is what their current investments are, assuming they held it for this whole amount of time, going back to like 2021. The orange line is sort of the 80-20 allocation that we're recommending with the remaining investments. And you'll just notice, right? I mean, we have the full report in the appendix of the plan here, but you'll notice just the trend of it is it grows more, right? It makes sense. It's higher equity. You would expect it to grow more over time. There is more fluctuations, but the rest of that money is going to be invested for long-term growth, right? That's the money we're doing the Roth conversions with. That's the money we're doing everything else with. And so that's really what we set up for them. We have a video that we did separate from the series of videos where we really get into the weeds of how we approach the investment, sort of using the factor investing and different stuff. We have some language of that in the plan here. If we have time in this video, I might come back to this, but again, there's an approach that we do. We use primarily ETF index funds to create the portfolios with some sort of specificity with the factor investing. And that's really what is represented in the chart here. So I'm going to turn it back to Hans, and then once we'll let him comment on that. And then I'm going to bring us into the software and really show you how all this, interacts with each other.
Yeah. So the investment plan, I mean, what's up here at numero uno, as Tom already spoke to, is manages risk. Is we're going to sit down when we do a retirement plan for you, a comprehensive financial plan like we did for Tom and Susan. This is the first subject we're going to start on. How much risk are you taking? How much risk do you think you're taking? How much risk are you comfortable taking? And then we want to point out to you, as you get older and older and older, that number is going to go down. You're just going to be able to stomach less risk typically when you're 80 than you do at 68, like Tom is. So we need to have in the thinking all of those things that I just said. We do risk assessment tools and all that. But what Tom pointed out is because of the annuities, because that took such a chunk of their money to guarantee $6,000 a month for the rest of both of their lives, that then there's plenty of money left, and the plenty of money that's left is really their inflation piece, their protection piece, and then we could be more aggressive with that piece because we've got so much of it in guaranteed income. So, and what you'll find in the plan is they went to 80% equities, 20% fixed. So they went with a much more aggressive strategy, taking into account the guaranteed annuities. We also need to look at market risk, which is that going up and down, longevity risk. That's reduced through annuities. Okay, is that when they put that money in those annuities, they've just taken market risk off the table. They're not totally off the table. There's an element to that of the market going up and down, but it's mostly off the table. And then, in addition, we've taken longevity risk off the table because that's what a lot of people are running out of money. They're concerned about, and they don't know how long they're going to live. For that piece of the money, it just takes it off the table. Tom has already talked to you a little bit about factors and tilting, our investment strategies. So we can be the managers of your money. We don't have to be the managers of your money. If you come to us with a financial plan, a lot of people say, I already got a financial guy. I'm a financial advisor. I'm happy with him. But a lot of times he or she's not giving them financial planning. They come to us, hire us. Many times they buy Medicare, they buy long-term care insurance, they buy annuities, and then they leave their money with their current financial advisor. A number of people come to us, that's on the table, and they end up moving their money to us for management. A lot of people are going to do that later in life, where they then are realizing that, when they can't do it, if they're people doing it themselves, we just kind of stand ready to do that piece. So the whole investment plan, what Tom is going to show you is the income plan, including the investment plan. Tom's going to take you into the software and show you where this all comes together.
Yeah, so we're going to go back through, and again, the very first video, we went pretty quickly through all the different software here for Tom and Susan, but I wanted to focus in sort of on this retirement section, because this is really where it's running through the Monte Carlo simulations. Again, that's where it's running through 1,000 different scenarios with returns randomized, really to stress test sort of their plan. Is how many chances do they run out of money? Do they not? You'll notice their current plan, this is sort of where they were when they met us. It's not bad, right? I mean, they weren't in a situation that things were just really looking bleak and they were going to be really in trouble. But our goal is to try to improve upon that. So 98%, very good. No concerns over that. 100% is better, right? We'd like 100% over 98%. But what gets us to the 100%? Like, what changes do we make from the current plan to the proposed plan? All of these are sort of listed in the variables down here. One is an asset allocation. Again, the remaining investments that's not in the annuities going to 80/20. So that's important. The tax strategy. So this is the Roth conversions. That's what we did in our last video where we looked at sort of what impact there. So that's brought into that. And then some big ones are down here. So the annuities, the SPIA is that 5-year annuity that comes in starting right in October, right when they retire. And then the deferred annuity, that's the one that starts once the 5-year one stops. So those are included there. And then when we look at the difference, right, when we add all of those changes in, we've increased the probability of success to 100%. And we've actually increased the ending balance. That's the projected ending balance of the portfolio. Again, the exact dollar amount, I'm not so concerned about because, the markets are going to fluctuate. Who knows where it's going to be? But when I compare one versus the other, if this one's higher than this one, I think that is a helpful comparison to look at. So the dollar amount, I mean, I don't in any scenario think they're going to end up with exactly this amount, right? I mean, there's too many variables to actually know that. But when this one's higher than this one, it's like that. I like that direction. Directionally, it's helpful. So we got over 6 million, 100% with the annuities. When we look at the cash flows, again, this is where we look to see what does this look like on a year by year basis. So if we look at 2026, we got a partial year salary, right? Again, he was an MD making good money. He's retiring. And then we got Social Security starting a partial year that year in 2026. And then the annuity, a partial year in the annuity coming in 2026 as well. One thing I will point out when we have the annuities, there's one set of the annuities back on the long-term care video we did where we purchased a long-term care policy with 300,000 of IRA money. That's accounted for from an income standpoint because we need to make sure we're accounting for the taxes. We're not upending any Roth conversion strategy. So that's here, but this is not money that can really be spent. So don't view this as money that's spent. Really, the spendable money is the 72,000. Again, the first year is only 18,000 because they're only getting it from October through December. But then starting in 2027 for the rest of their life, they're getting 72,000 a year guaranteed forever. And so when we look at that back at the summaries, as we got 186,000 coming in, we have expenses of 166. The tax payment is a little bit elevated because of the Roth conversions. And actually, let me double check where we have the Roth conversions set right now. Yeah, let me put it back to where we actually recommended for them. Sorry about that. So now we'll go back to cash flows. Summary. So same thing. So we got the income coming in. We have this, again, the tax payments a little bit higher because of the Roth conversions coming in. But then you'll notice it drops off, once Roth conversions are done, it drops off pretty significantly. And so we have enough money to cover their spending, get them the 10,500 they need. Again, the expenses, part of the insurance, this is the long-term care, those sort of offset each other. So when you do the math, the total spending is right at 10,500, which is what their goal was. That's after tax, and then we got to account for the taxes over here. So all of it sort of works out, flows through here. But at the end of the day, really what we're talking about here is guaranteeing their income, removing market risk, being more aggressive with the rest of the money, and the end result is a higher probability of success with a higher ending balance going to their kids, which they like, for them, that was important to them. And this just made a lot of sense. And so let me turn it back to Hans and see if he has any other comments here.
Yeah, we just try to give you a bird's eye view of the stuff we do behind the scenes, but then we meet with clients that we're doing a plan for 2 or 3 times or more during the making of the plan to show them the software and show them what we're thinking about recommending, get their input, get their reaction, so that by the time we get the plan completed, we're through all 7 things and these meetings, done all the calculation, then we're going to produce that plan where we're only going to give them one recommendation in each area. And then we're not through fiddling with it yet. I mean, when we present the plan, we have many people that we make adjustments after that before they start implementing. So just trying to show you the process of building the income plan. I want to talk a little bit about estate planning, because all I want to do is mention that is when we're doing this income plan, I mean, we've got to take into account that one of them may pass away well before the other, and you're going to have a surviving widow or widower, possibly for a long period of time. And what happens? Well, the Social Security check, there for Tom and Susan, it would go to $42.98 a month plus inflation. So the smaller Social Security check is going to stop. That's going to be a loss of income, and we got to account for that. The IRMA brackets are going to cut in half. So what is $218,000 is the start of IRMA for a married couple today, is for a surviving spouse, that's $109,000. So IRMA is effectively, could be more than double. Then you got tax brackets are cut in half. So, when you have a single, the 24% bracket is about 200,000. And you can see up here it's 403,000 for a married couple. So if you got somebody on a Roth conversion strategy and then one of the spouses dies, then we're going to have to finish that Roth conversion strategy at much higher tax rates, which may blow the whole thing up. So the annuity income, very importantly, is unchanged. That's one of the reasons we do that kind of annuity, because with all this other stuff going on that's bad, at least for the widow, that $6,000 a month is just going to be there, and it's going to continue on until the widow passes away. So that's the estate plan, and we're just kind of foreshadowing. The next video, we're going to be going over Tom and Susan's entire estate plan. And then we want to talk about the tax plan, just kind of as an afterthought, is the Roth conversion in Tom and Susan's plan is to keep them right below the IRMA threshold. The income tax is calculated and paid after spending. I just wanted to go over the bottom up. So, we're building it from the bottom up. We're going to have that $10,500 a month, and then the tax is going to be on top of that. Ordinary income tax, capital gains tax, we got to deal with both of them in the planning. And then they're going to have 3 buckets of money. They're going to have taxable, where they're paying current taxes, but they already paid tax on the principal. You're going to have tax deferred, and that's money that we're not currently paying taxes on, but we will in the future if we take anything out of it. And then you have tax free, which is the Roth, and any life insurance that they own. In Tom and Susan's case, I don't think they have that. And then managing tax brackets year by year. I just want to make out the point that we're going to project all this stuff out for 30 years. And really, the first couple of years, 2026 and 2027, we're pretty much going to stick with. But every November after that, we're going to be looking at what we already know in January to November. And then we're going to look at what we said we're going to do for the year, and we're going to make adjustments. And we're going to do that all the way through retirement. So just kind of putting a cap on things. We talked about IRA 401k today. We haven't really talked about long-term care, but baked into their plan is the expense and the moving of money of that that IRA funded long-term care. We talked about IRMA, and then we certainly talked about taxes. So with all that being said, I want to bring Tom back on. I'm Hans Scheil.
And I'm Tom Griffith.
And we thank you very much for listening.
Thank you.